Hello, welcome to my channel today. This is King's Tutor. First time of joining us, thank you for clicking to this. Ensure you like, comment, share, and subscribe to our channel. Okay, now today we want to see the CVP analysis. Okay, the CVP analysis tends to look at how the cost and the profit changes as a result of changes in the volume of activity. Okay, so the C in this stands for the cost, the V stands for the volume, YP stands for the profit. Okay, so the CVP analysis tends to look at a technique whereby we study the behavior of the profit as a result of changes in the cost and what prices. Okay, so the volume is the center of activity when it comes to the cost and the profit, because if the volume increases as regards the the total number of items to be produced, it may also affect the cost. And also, if it reduces, it might also affect the cost and also the profit. Okay, so the CVP analysis tend to look at how the cost and profit is being affected as a result of changes in the volume of activity. Okay, so the cost, like we all know, the cost refers to expenditure made to acquire a particular item. Okay, it might be a raw material. Okay, so the cost is the expenditure made to acquire a particular item. So we know the cost can be the fixed cost, it can be the variable cost, it can be semi-fixed or semi-variable. Okay, so the fixed cost is the cost of an enterprise that do not change with the level of output. They remain constant irrespective of the output level. Okay, while the variable cost is the cost of an enterprise that changes. It is also known as what we call a direct cost. It's a cost of an enterprise that changes with the level of output. Okay, while the semi-fixed is that cost in which parts is fixed and parts is variable. Okay, so the cost refers to the expenditure made in acquiring an item. Okay, while also the volume refers to the quantity. Okay, refers to the quantity of an item, maybe a product. Okay, the quantity of an item or a sale. So while the profit refers to an efficiency in the use of resources. Okay, we can see profit in terms of the economic view of profit or the accountant view of profit, but that's not where we're going. So the CVP analysis tends to look at how the cost and the profit changes as a result of change in the volume of activity. Okay, so there are underlying assumptions as regards using the CVP analysis. Underlying assumptions, we're going to see them because these assumptions we have to be if we are going to use this. Okay, so let's see some of the assumptions. Assumptions of CVP. So one of the assumptions is that costs are either fixed or variable. Costs are either fixed or variable. So it doesn't give room to either semi-fixed or semi-variable. So it is assumed that while using CVP analysis, the cost of the enterprise are either fixed, like salaries and depreciation costs, or the storage costs. They are either fixed, that is, they do not change with the level of output, or they are variable, that is aspect of cost that changes with the level of output. So this is the two classification of cost as an assumption for using the CVP analysis. Okay, now why the second one is fixed cost remains unchanged irrespective of the level of output. That is what we have said while we are defining fixed cost. It's assumed, the second assumption is that the fixed cost remains unchanged irrespective of the level of output. Okay, it is served as fixed cost, it remains unchanged even if output is increasing or decreasing. That is one of the assumptions. Okay, now that's the second one. The third one, volume is the only factor that will cause the cost and profit to change. Okay, so one of the underlying assumptions of the CVP is that the volume is the only factor that will cause the cost and the profits to change. That is, if cost is changing as regards the expenditure that will be incurred, it's what is subject to what the volume alone. And also if profit will also change as a result of a more or less of an item to be sold, it is also as a result of the word volume. So it's assumed that volume is the only factor that will cause cost and profit to what change. Okay, that's the third one. And the fourth one, variable cost per unit is constant irrespective of the level of output. A variable cost per unit is constant irrespective of the level of output. Okay, a variable cost per unit, the formula can be given as the variable cost over quantity. Okay, we give us the variable cost per unit. Okay, so we said the variable cost per unit is constant irrespective of the level of what output. Okay, so the fifth one, selling price per unit is constant. The selling price per unit is constant. Okay, so that is the fifth assumption. And the selling price per unit is selling price divided by the quantity of item to be sold. Okay, selling price per unit is what constant. Why the sixth one, production and sales are equal. That is, there is no closing stock. So one of the underlying assumptions of the CVP is that the production and sales are equal. There is no closing stock. That is, once an item is produced, that item, the totality of it, is also being sold. Okay, it's also being sold. So there's no closing stock that's remaining at the end of what the year. So that is one of the assumptions of the CVP. Okay, so the seventh one, a level of technology and efficiency remains the same. The seventh one is the level of what technology and its efficiency remains the same. Okay, that is the assumption. The seventh one. While the eighth one, risk and uncertainty is non-existent. Okay, so one of the assumptions is that there's no risk and uncertainty in the CVP analysis. Okay, so we are certain about the outcome. So that's one of its what assumptions. And the ninth one, only one product is produced, and where there is multi-product, sales mix is constant. Okay, so also one of the assumptions is that only one product is produced, and where there is multi-product, sales mix is what constant. Okay, so that is a ninth one. Why the 10th assumption that we're going to see is that contribution per unit is constant of each unit sold. Of the same product. Contribution per unit is what? Constant of each unit sold. Okay, so these are the underlying assumptions of the CVP. Okay, so what is contribution? Now, contribution is seen as the sales revenue less the what? The variable cost. Okay, that is, we get contribution. Contribution is seen as the sales revenue minus, or what we call the total revenue, minus the what? The variable cost. Okay, that is what? The contribution. Okay, the sales revenue minus what? The variable cost will give us contribution. Okay, so these are some of the assumptions of the CVP analysis. Okay, so let's move to the next part, which is a break-even analysis. Now let's see the break-even analysis. Now, break-even analysis tend to look at the level of sales at which the cost and the revenue are equal. Okay, it is that point of the sales in which there is no profit and there is no loss. That is, the cost incurred and the revenue generated from the sales made are equal. Okay, in economics, we want to call this what we call maybe constant demand. We want to call this equilibrium. Okay, so break even, like we said, is a level of sales in which the cost and the revenue are what are equal. Okay, now the break even tend to look at it. Most firms use this as a strategy. Okay, once they are coming to a market and they are new, or a particular product, if the firm is not new or that particular product of that firm is new to the market, now most time they might want to enter into good pricing strategy by reducing their price. Okay, so by doing this, they want to know at what level of sales, at what level of sales would they be at break even, meaning that even if they are not making profit, they will not also be incurring loss. Okay, so they want to know at what level of sales will ensure that the cost they incur in terms of what producing that item will equate their revenue they will make when they sell it. Okay, so the break-even analysis tend to look at the level of sales at which the cost and the revenue are equal. Okay, now we have two aspects or two method of solving the break-even analysis, or what we call the break-even point. Okay, so remember, the break-even point exists where the revenue equates to what? The total cost, where the total revenue is equal to what? The total cost. Okay, now the two methods of solving the break-even point is, the first one is the formula method, while the second one is the graphical method or the chart method. These are the two ways we solve the break-even point using the formula, in which we'll be given a question in which we have to apply the formula. Okay, we're going to see different formulas as regards the break-even point, and also the graphical method in which we'll enact a graph in which we have to check through the graph to see at what level of sales is the total revenue equal to the total cost. Okay, now let's see the first one, which is the formula method. The first one, which is the formula method. Now, the first formula we're going to see as regards the formula method is the break-even point in units. Okay, the break-even point in units. Where is the break-even point in units? What is the formula? Now, it will be the fixed cost over contribution per unit. Okay, that is the break-even point per unit, the formula. And remember, I've said it before that the formula for contribution in units is the selling price per unit minus the variable cost per unit. Okay, selling price per unit minus variable cost per unit will give us the contribution. So the break-even point per unit is given as a fixed cost over selling price per unit minus variable cost per unit. Still the same thing. Okay, so that is break-even point in units. Remember, now if we now have B, the break-even point in sales or Naira value, okay, in sales value, okay, it will now be the fixed cost over contribution per unit. Now, this times the selling times the selling price per unit. Okay, now this will give us the break-even point in sales value. Okay, so it is a fixed cost times the selling price per unit divided by what? Contribution per unit. We already know what is contribution per unit. Okay, so that is a break-even point in sales. Now, why the next formula, the C, is contribution to sales ratio. Contribution to sales ratio, which is also known as the profit volume profit volume ratio. Okay, now the contribution to sales ratio to be given as contribution per unit over selling price per unit times 100%. Okay, now the contribution to sales ratio, which is also known as the profit volume ratio, is given as contribution per unit over sales price per unit times 100%. Okay, so that is the C. Okay, now the D, sales level to achieve a target profit in units. Sales level to achieve a target profit in units. And most time, a businessman will want to achieve a target profit. Okay, they want to know how much worth of goods would they have to sell to attain that height. So it will now be the fixed cost plus the target profit that you want to attain, all divided by the contribution per unit. Okay, so the sales level to achieve a target profit in units is the fixed cost plus the target profit divided by the contribution per unit. Okay, now the next one will be, so it will be sales level to achieve a target profit. Now this will not be in sales value. Okay, in sales value now, not in unit. Now it will be given as the fixed cost plus the target profit. Now this TP stands for target profit, please, times the selling price per unit divided by the contribution per unit. Okay, the sales level to achieve a target profit in sales value, it is a fixed cost plus target profit times the selling price per unit divided by what? The contribution per unit. Okay, so that is for E. Now F is sales level to achieve a target profit after in units. Okay, in units. Now it's sales level to achieve a target profit after tax in units. Now it will be the fixed cost plus profit before tax divided by the contribution per unit. The fixed cost plus profit before tax over contribution per unit. Now you might want to ask, so what is the profit before tax? Now note that the profit before tax will be given as the target profit over 1 minus the tax rate. Okay, so the profit before tax in this situation now will now be the target profit over 1 minus what? The tax rate. Okay, so Y, this F, Y our G will now be the margin of safety. Now there's what we call the margin of safety. The margin of safety is the difference between the budgeted sales and the break-even sales. Okay, so most time we express this in terms of percentage. So it will now be the margin of safety will be given as the expected sales minus break-even sales divided by the expected sales times 100 over 1. Okay, so the margin of safety, like we said, is the difference between the expected sales and the break-even sales. So it's given as the expected sales minus the break-even sales over the expected sales times 100 over what? 1. So that will give us the margin of safety. So these are the formula method of solving the break-even point. Okay, so we are going to see a question and let's run down through again. The break-even point in unit is given as the fixed cost over contribution per unit. Okay, the fixed cost over contribution per unit. And we said the contribution per unit is giving us the selling price minus the variable cost per unit. Selling price per unit minus the variable cost per unit will give us the contribution. Okay, why the break-even point in sales value is a fixed cost times the selling price per unit over contribution per unit. The difference between this and this is the sales value. It means that you're multiplying by what? Selling price per unit. Okay. Now, why C, the contribution to sales ratio, which is also known as the profit volume ratio. And most questions, they might not say contribution to sales ratio. They might say the profit volume ratio. Okay. It is given as contribution per unit over selling price per unit times 100%. Okay. Why the sales level to achieve a target profit in unit? I will said most time, a seller might want to achieve a target profit. So they want to know the level of sales for them to achieve that. So it is just a fixed cost plus the target profit, the profit you're looking at, divided by the contribution per unit. Okay. While E, the sales level to achieve a target profit in sales. This one is in unit. So it is still the same thing. The fixed cost plus the target profit over contribution per unit times the selling price per unit. Okay. While F, the sales level to achieve a target profit after tax in units. What's the sales level to achieve a target profit after tax? So it is a fixed cost plus profit before tax divided by contribution per unit. Now, you ask, what is the profit before tax? It is target profit over 1 minus tax rate. You might be given a tax rate in the question. Okay. Why G is a margin of safety. Margin of safety, like we said, is different between the expected sales and the break-even sales. It's normally expressed in percentage. So it is given as expected sales minus break-even sales divided by expected sales times 100 over 1. Okay, so that is the formula method of solving the break-even point. Now we're going to see a question that will reflect this that we're going to use to solve before we move over to the next one, which is a graphical method. Okay, ensure you have liked this video so you don't miss any part in this. Okay, ensure you like. Please comment where you're watching me from, your department or the course exam you're preparing for. Okay, and share this video to other aspect of student on your wall on social media. Remember, we're on different platforms. We're on Facebook, we're on Instagram, we're on TikTok, we're on YouTube. Ensure you follow us on this platform. Okay, thank you very much. Ensure you like, comment, share this video. Okay, now till we meet again. Now I want to recommend a video for you to watch. Now you see this video popping up now. Ensure you watch it. Thank you very much.